Morning, Simon.
So we're just going to give this a few more minutes and have some, make sure everybody can get in to join us. Meanwhile, I'm Simon McGowan. I'm with Rocky Mountain Insurance Network. We are a brokerage general agency based here in Colorado. We're excited today to have both Elena Castor and Andrew Clapp on from AIN, our national IMO affiliate based in California. And today we're talking, as we can see on this amazing slides here, asset-based long-term care from an underwriting perspective. And we're also going to get some market updates, I believe, with some changes that have happened maybe in the last, few months, right?
Yeah, we'll cover those at the end.
Perfect. So I think, looks like we've got a good number of people on here now. So with that said, maybe we should get started, and we try to keep these short so that people can get on with what they're doing.
Exactly. Well, welcome everyone, and thanks for having me back, Simon. I appreciate it. For those of you may have been on our past calls, we've always taken that sales strategy focus. We've talked more recently on the tax advantages of a non-qualified annuity strategy to positioning clients who can work with qualified assets. So we have been sales focused in the past. Today, we're going to have a little bit different twist. We're going to, discuss, if you will, from an underwriting perspective around asset-based long-term care plans. And of course, why this is so important to you as an advisor and for your clients. So let's get started here. My space bar always freezes on Zoom when we go live. I don't know why. So when we get started here, I do want to first touch on the different types of plans. So I've broken down our asset-based plans from our life insurance-based plans that you probably are familiar with, Lincoln's Money Guard, and now their new Market Advantage on a variable chassis, Nationwide's Care Matters plan, Securing with their Secure Care, and One America's Asset Care. On the annuity-based side, we have One America and Global Atlantic with the asset-based annuities. They both have simplified underwriting, but there are some nuances that do go on with underwriting when we are looking at these plans or applying for these different plans. So one differentiator here is One America. On their underwriting, they underwrite just a little bit different. And if I can get my cursor, there you go. So when we're looking at the life-based plans, we're looking at underwriting concerns for mortality and morbidity. When we're looking at the annuity-based plans, we're looking at morbidity concerns mostly. So this is key because sometimes if we have a case come to the table, advisor, knows the client, for example, may have had adult onset diabetes, right? That's insurable, but they want to see it well controlled because that's a mortality concern. If they're not well controlled, maybe the annuity is a better fit. They're not as concerned, so it doesn't need to be that well controlled than if you're looking at a case on a morbidity basis. So sometimes we're pivoting. Sometimes the annuity is a better fit. Sometimes the life insurance is the life component plans are a fit. It just depends. The more we know about a case, the better. So, I mentioned why this is important for you as an advisor, why it's important to the client, in understanding some of the underwriting differences here. One America on the life component side is our only carrier that will rate up to 8 tables. Typically, and pre-COVID, our carriers would issue or decline they will issue a policy up to 4 tables. So your clients can have that medical history. And as long as they're within 4 tables on the life component plans, they're going to issue as applied for. So if you applied for a couple's discount or maybe standard single rates, issued as applied for up to 4 tables. The one exception here, again, One America, currently they still have a COVID underwriting guideline for anyone 70 plus. They're requiring that the client be standard or better. So ideally in the near future, maybe we'll see that lifted and all our carriers will be back to normal underwriting, if you will. Most of them are already there. So those are the key differences. It is important, to understand some of these differences because we are seeing declines out there and postponements, and some of them are big surprises for the advisor client. And so, the solution to that for me, from my perspective, is really all we need to do is take 5 minutes, pre-qualify your client, get the green light before we go into underwriting. And my screen is frozen again. Sorry about that. There we go. Sorry about that. So regardless of age, if your clients have any medical history that you're aware of, typically when you're doing risk planning, you probably already have a lot of the facts on your client. Take an extra few minutes, get them pre-qualified. It's a very simple process. You could do one of two things. You can give Simon or myself 5 pieces of information: client's age, height and weight, what are their diagnosed conditions, what was their treatment, and a list of their medications. All this information, again, you probably likely already have this if you've done other risk planning for your client, but by doing that, we can get an underwriter response same day with what I call a quick quote. You'll already qualify your client, or you can go via the informal inquiry, paper, have your client fill something out and submit that. If you are interested in pre-qualifying a case, work with Simon, work with me, and it's just a very quick process to get through. But again, because we're seeing postponements, declines, it's never a good situation, because now we may have an MIB hit, we have an unhappy client, and for me, unhappy clients mean unhappy advisors, and the best solution, is to prevent it altogether. So let's look at the significance of this. When we don't pre-qualify a case, we could possibly see a postponement. Those postponements go anywhere from, call it 30 days to 5 years, depending on the medical history of your client. We could get a decline, or with One America, a possible rating. Product availability becomes challenging. Once you get that decline, you've now limited some options for the client. Like, what's the next best plan? You have to pivot to something, right? So this is typically where I get a call saying, what is the next best option? One of our carriers, if we can't approach automatically on a decline because they have a 12-month waiting. So if a client does get postponed or declined, we've eliminated one carrier and their product, which is Global Atlantic, who happens to be very competitive with their with their asset-based annuity. Now, assuming you do pre-qualify, and I know many advisors do qualify, and it's great to see that, but what you're doing is you're narrowing down the appropriate long-term care product options for the client. For your next meeting, you're going to have some very specific recommendations, because you've already received the green light from the carriers, if you will. And overall, once that case gets into underwriting, you are going to experience faster and more efficient underwriting to get that policy placed. And at the end of the day, yes, advisors, you will get paid, which is great. So I can't say enough about the pre-qualification process. Less than 5 minutes of your time, we can avoid, getting that unforeseen decline, rating, or postponement. So I do have a couple of case studies we're going to get into. The first up is going to be the unforeseen decline. And this is going to be, my examples are going to be using that 70+ demographic. These ages play well into the asset-based annuities for some great leverage. So I wanted to focus on this demographic, particularly with both case studies. So let's look at a case. We had a couple come to us throughout COVID. The husband ended up being a decline. Now, we weren't involved in the pre-planning on this case, so it kind of came up as a surprise, but the husband was declined. He didn't have COVID. However, he had it before he applied and was over it, but his residual symptoms were very challenging from a substandard or mortality perspective, so he ended up being a decline. He was at that, over 70. We needed to be standard or better, and he did not make the cut. So the plan that he applied for, this couple preferred an unlimited benefit design, and they were at $4,500 a month by their age 80. But again, they wanted that lifetime benefit. And so they were upset. The advisor had come to us to see what the next best option was. As I mentioned earlier, we've eliminated our next go-to or pivot product where we can get pretty good leverage at this age is the asset-based annuity, but now we've eliminated one product. So fortunately for this client, One America, anytime an underwriter declines or postpones a case, they're going to come back and tell you in that same communication, we're a decline for asset care. However, we will, approve this client for an annuity option, and they normally state what duration they approve you at. For this case, he got a lifetime approval for the annuity. So it was the next best option for him. And if you look at the benefits, we were shy roughly $80 on what they had applied for the $4,500 a month. They ended up with $4,428, but still got their lifetime benefits. And that was key here to this case. And by doing so, because of the annuities being fixed and guaranteed, we got actually a higher cash surrender value. So that live, quit, or die mantra in this particular case, we don't lose that. If the client lives to use the benefits, they're going to get great leverage because it's unlimited benefits. If they pass away or walk away, they have that $120,773 to work with. So the asset is not lost here. Now, technically, as you see on the death benefit, it says 0, but we would be pivoting in the event of death to that cash surrender value because it is guaranteed. All right, so that's the decline situation. I want to flip this now. Let's look at a case that we did get involved in early and upfront, and we pre-qualified. This was a 77 male. He had $150,000 of single premium to work with. We had 3 carriers that gave us the green light, but this advisor did not have any experience on the asset-based annuity. So this was all new to him. So I broke these down into the overall products. We're just going to start with the life component plans. Those green lights were from One America with the asset care and Lincoln's Money Guard product. So these were the specific options that we knew we had the green light with. The advisor looked at these and thought, okay, asset care looks great here. We've got a higher death benefit. We've got more long-term care benefit, which is what the client was focused on. Everything looks great. But now let's consider the annuity options that were brought up in the conversation. And can we do better and leverage here for this 77 male who's pre-qualified? So I've listed the annuity options that we positioned. So total of 5, products basically that we looked at. Now, again, fixed annuities don't technically have a death benefit, right? But look at what happens when we do look at that annuity with that guaranteed cash surrender value. It exceeds the cash surrender value in our life component plans, both with asset care and Money Guard. So we basically, 100% return of premium, if you will, or guaranteed cash surrender value. If this client was looking to possibly walk away, or if they passed away, to make up, it's the same as paying out as a death benefit. So overall, 4Care was the chosen product here because, again, the client's focus was not necessarily death benefit, but long-term care benefits. But a good nugget to close the sale with is that the cash surrender value in these annuities ended up being higher than the other plans that the advisor thought was the best option. So win-win for everyone. By pre-qualifying your case, it just calls for thorough options, a good selection for your client, and a very strong chance that you're going to get through underwriting and get your case placed. So can't recommend it more. Pre-qualify. I'm always shouting that out. I can't say it enough, but I'm going to move on here. I hopefully didn't talk too fast through the underwriting piece, but we will open this up for questions. End of the day, when we don't pre-qualify, it just becomes challenging to find the next solution, if you will, because we have limitations. When you do pre-qualify, you're coming strong out of the gate with a high likelihood of getting that case through underwriting and very quickly. Anytime I give a quick quote out, it's an email format. All you have to do is attach that to the application process, and it's no brainer. The underwriter gets that case in underwriting, and they can very quickly move on that case and make an efficient, very quick decision. All right, so I promised Simon that we were going to talk about some key changes going on in the industry. And we do have a few changes to talk about here. So I'm going to pivot. I want to talk about Lincoln's MoneyGuard 3, which is their product in all states except for New York and California. Their product over the past couple of years has been, fairly expensive, if you will, because of their increases. But they took a different approach over the last 12 months. We saw 2 rate reductions on that product. The last one that just came in January of this year, we saw the biggest impact on the 6-year 3% design option. So we saw up to 17% reduction between ages 55 and 65, and up to 16% for ages 45 through 54. And I say that's significant because they are pricing in the top 3. If you're comparing side by side, they are going to be in the top 3. That 6-year design, again, being a very popular design for many, has definitely got them back on the map. It's been very active in case design with the MoneyGuard 3 plan. Now, MoneyGuard 2, only available in California. They just discontinued the New York product, but they saw lesser reduction. However, if you do planning in California, still competitive against, say, Nationwide's Care Matters plan, you're going to see these plans still be competitive on that 6-year design. They did away with the 7-year design. So now we can design a plan anywhere from 2 to 6 years on the Lincoln MoneyGuard product. What else here? We do have a funding change. Lincoln MoneyGuard 3 is now, you can do those funding years as a single and anywhere in between up to 10 years. Previously, we were able to fund, say, up to 40 years, and they changed that going forward. So that's the Lincoln MoneyGuard update. They're back on the map, solid product, solid company. So if you haven't been looking at them, definitely worth taking them into consideration. Now let's talk about automation. This is something you're probably aware of. Most carriers nowadays are doing e-app because it gives way to just quicker underwriting. However, 2 carriers for the asset-based plans, Nationwide, and Lincoln, have offered the personal phone history interview to be done online. So that's the bulk of the underwriting, right? Because it's simplified. So all that medical history that gets done can now be done electronically, with the exception of certain ages that may need to complete the cognitive piece of that interview over the phone. But that phone call now just went from 20 to 30 minutes before this was offered on an e-basis to now a 10-minute call. So much more efficient, fully automated. And for those clients who do not need the cognitive, you're going to see those cases that come out of underwriting pretty quickly. If you're working with paper apps, I don't recommend it, but just know that paper apps are experiencing delays with carriers. That's the expectation that I'll message to you there. If you are still doing paper apps, they're still accepting them. Just know it's not the most efficient or timely. Washington CARES Act. Won't spend too much time here, but for those of you who may not be aware, this was a mandated tax for long-term care that was forced upon Washingtonians. They've been able to push this tax back to July of 2023. They did allow they allowed Washingtonians to opt out, if you will, of the tax. And that tax was 58 cents, for every $100. So they did have an opt-out opportunity. Hundreds of thousands of people took advantage of that. Carriers went into backlog mode with new business. And as of today, they're pretty much, seeing light at the end of the tunnel. They've cleared out pretty much all of that business now. They actually froze Washington business for any asset-based plans at one point. Even the life carriers were not offering long-term care or chronic illness riders in the state, but they've all opened back up on the asset-based side. And we're seeing the life carriers open back up in the state of Washington as well for the long-term care and the chronic illness riders. So keep that in mind. And if anything that you can take away from this as a talking point when you're doing risk planning with your clients, do let them know and be aware that other states are considering this tax mandate for long-term care. California, Minnesota, probably the two most active states that are looking at this strongly right now. California is a big state, so good opportunity to bring this up as an awareness point in your conversation with your clients. All right, so I'm going to move on here. I want to talk about a big product change that just happened in the past week. If you're not familiar with Securian, aka Minnesota Life, their past product, Secure Care, still available in some states, but it was on a universal life chassis. It's their indemnity plan, as opposed to the reimbursement model. They basically revamped the product, if you will. The new plan that went into effect just last week is called Secure Care 3. It's on a whole life chassis, so very different, but still an indemnity model plan. So when clients go on claim, all that means is they're going to get their full monthly benefit. If it's $10,000 a month and their expenses are $5,000, they're going to get $10,000 a month. So that's the indemnity model. But the big changes here, they changed up how we design that product. We could design up to 7 years, duration with this plan. In the new plan, we can design up to an 8-year plan. So very different there. They basically changed the base, and that's your acceleration for long-term care, what I call the base policy. We used to have 2 and 3 years options on the base, 2 to 4 on the extension rider. They changed that up to just 2 years and 2 to 6 years, giving you that total max benefit duration of 8 years. Return of premium. We had that built into the product on Secure Care. It was built in at 100%. Today, they changed that up. We now have 3 different options. If you use the LTC boost, which is basically just the policy's guaranteed cash surrender value, really, we didn't see much change in the pricing if you go that option, and it's still competitive against, say, the 6-year 3% design with other carriers. That happens to be their sweet spot on the new product as well. So still very competitive. When you start looking to add on 100% return of premium, you want to vest up, you're going to pay for that with an additional premium cost. Same with the 75%. But in doing pricing, very interestingly, that 75% it's not significantly going to change that premium, but it does change it. Something else worth mentioning here, waiver of premium has been added and it's optional. They didn't have that on this product in the past, and only one other carrier on our asset-based plans has offered waiver of premium and has that, and that's with One America. So I like that they've added this on and they've made it optional. In looking at that pricing, it's cents on the dollar. I would say add it to all of your case design. If you are looking at this product, definitely add the waiver of premium. Another great enhancement on the new product is that we have more flexibility. In the past, it was very challenging to say, do a lump sum or 1035 of say 50,000 and add on a lower ongoing premium. We could do that with other carriers. We couldn't do that in the past product. Going forward, we now have that option. So we've opened the window there to be able to consider the Secure Care 3 product in our planning. So really good overall product updates. I like what they've done with the product. It still prices competitively depending how you are case designing, but we have those options to move the levers up and down and how you want to design your case for your client using those ROP options and the waiver of premium. Excuse me. So that's it. Hopefully I didn't talk too fast through this. Any questions that we can get to, I'm going to hand the controls over to you, Simon, and we'll go from there.
Sure, thank you. We do have a couple of questions. The first one being, are these approved in New York? And I think you spoke to a couple that were not, but I think some of them are, right?
Which plans, the Secure Care or?
This came earlier on, so I think from probably.
Got it.
Yeah.
Right. So the plans currently available in New York on the life. Let's say they just took away the money guard, so now we have nationwide in New York. We have a carrier here that's going to be upcoming available in New York as of April 25th. That's going to be an asset-based plan by Mass Mutual. So that's upcoming, almost available. And I believe that's it on the life component plans. On the annuity plans, don't believe we have availability currently in New York, because on the annuity side, we have One America and Global Atlantic. So we're limited there for placement in New York. So just
Good.
2 carriers basically right now. And again,
Perfect.
the Mass Mutual product will be available on April 25th.
Okay, great. And then the other one that we had was, do we do a comparison of life versus annuity options on every inquiry quote that comes to us?
And that's a great question, because I probably didn't touch enough on that. So when we're pivoting, what's the best options? I used that 70+ demographic throughout the case studies, because typically that's where we can get maximum leverage on long-term care benefits, if that's what you're looking at. Sometimes we see it on the cash surrender value as well. And it can be a really good option for those clients. Personally, for me, if I'm assisting someone on case design, I start looking at age 67. Sometimes I'm able to get leverage. I've worked with couples where we have a 72-year-old husband, 65-year-old spouse, or maybe even a little bit younger. And sometimes that annuity option, depending how they're funding it, we can add an inflation rider on there. We could really maximize that benefit pool using the asset-based annuities. So 67 and up, I start looking at them. But again, if you're going through the pre-qualification process, you're going to know upfront if that annuity option is attractive. You're going to know in that pre-planning process if that's viable for your client.
So rule of thumb on a healthy client, if they're under 67, life-based products are probably going to be better.
Typically, yes. But again, if you're doing pre-qualification process, you might automatically upfront in the planning process be pivoting to an annuity if they can't qualify, for example, for the life component side.
And just to say, because the question goes on to ask, or at least they state that it seems to be an excellent way for an advisor to grow in knowledge, especially at the various companies. It absolutely is to be able to do those comparisons. But you're also right when you say at the end here, it's a bit of work for us. It is. So yes, we will do so if it's deemed necessary, if that makes sense. But if you could send us those 5 bits of information, we are happy to do those. And then we can come back and help with that case design and steer you in the right direction.
Yeah.
And if you want to look at other stuff, we'll show you other stuff. But
yeah, and I could bullet point, the basics that we need to get a quick quote, same day on the client to get them pre-qualified. The more we know, the more we provide the underwriter up front, then the more solid that, that feedback comes into play when we go into underwriting. So.
And if they decline on a life insurance policy, so if they've applied for a life insurance policy, in the last year or so, and they've been declined for that, they're likely going to be declined for these as well.
Yeah,
right?
It becomes challenging to pivot to another option for sure. And of course, we have the 12-month waiting with Global Atlantic on that 4-care annuity.
But I mean, we're not just talking asset-based long-term care policies. We're saying any life insurance policy that you've been declined for, there may be an issue.
Been declined for a rider, right?
Yeah. Okay, just wanted to clarify that.
Yeah,
so, yeah.
Typically, I do have people that come to me, they've been declined for the LTC rider. So again, it becomes challenging, even on a life sale where the rider's been declined, it's going to be challenging to bring it over to the asset-based side. But we will look at it, if we can get them qualified for the asset-based annuity, that's the next, go-to where we can get them similar leverage.
So we try to say this with all more difficult cases, medical first. If you could send it to us first and we can take a look at it, we're going to be in much better shape. Please do that.
I would say probably save a couple hours off the planning process.
And heartache when you have to go back and explain why it got declined. Right. So, guys, this is great. Thank you. Really, thank you very much for this.
Yeah, if there's any follow-up questions that you can think of, or if there's a case you want to discuss, feel free to reach out to Simon and myself. We're here and be happy to, work with you and your clients.
Perfect. Well, Elena and Andrew, thank you so much for joining us. And everybody else, have a great afternoon, great weekend. Talk to you in a bit.
Bye, everyone.